Make no mistake. I mean, the system is cyclical, and we go from boom to bust, and we go from from benign to crisis periods. That's the nature of the financial system. Just for reference, the shaded area begins in 2025. It's just because this is annual data. It looks as if it's coming earlier, but that's what. So the last observation, the true observation, is 2024. So what we're starting to see is that line climb. Now, will we get a crisis? Yes.
Welcome back to Metals and Miners. I'm your host, Gary Bohm, and today we're plunging into the intricate world of global liquidity, precious metals, and the macroeconomic currents steering commodity markets. I'm excited to introduce Michael Howell, founder of CrossBorder Capital, whose pioneering work on global liquidity flows has been shaping investment strategies for decades, with a keen eye for decoding central bank policies and their impact on assets like gold and metals. Michael offers a unique perspective on navigating today's volatile markets. Michael, it's always a privilege to have you on Metals and Miners. Welcome back to the show.
Gary, great to be here. Lots to talk about. Exciting times, I think, in markets for investors to watch.
It is. All right, Michael, let's begin with taking us through your Global Liquidity Index and showing us what trends it's been in and what's coming around the corner and in what time frame that you're expecting.
Okay, well, I think the easiest way to say that is, first of all, that we're focused, to say what we're focusing on. We're focusing on global liquidity, which is basically a measure of wholesale money that is winging through global financial markets. It's really the pool of savings and credit that moves around the world. And it's effectively a sort of measure of the balance sheet capacity of credit providers. And it's particularly important when it comes to understanding debt and debt roll. And the point that we keep making is the entire financial system is essentially geared to rolling over debts. Forget the whole idea that's in textbooks about raising new capital for productive investment. That finished long ago. We're now in a world where debt is paramount and we've got to refinance debt. And therefore, balance sheet capacity, in other words, global liquidity, is critical to that question. Now, the global liquidity cycle is essentially a debt refi cycle. So in other words, the cycles in liquidity pretty match the tempo or the frequency of maturing debt. So the average maturity of debt in the world economy is about 5 to 6 years. Hence, you get a 5 to 6 year global liquidity cycle. That cycle bottomed in October of 2022. It's been rising pretty much ever since. There's been a few sort of coughs and splutters on the way, but generally speaking, it's still going up. And in fact, the latest data that we've just had out for the end of May shows another big uptick. And in fact, central banks have been pacing the increase. They've been injecting a lot more liquidity. The slower tempo of the world economy has encouraged many to ease. And what's more, you've got a weaker dollar, which is also forcing or encouraging a lot of other central banks, particularly in Asia, to add liquidity. So the picture at the moment is pretty benign. I mean, I think there are question marks on the horizon for sure, but we're still on an upswing of liquidity. And while liquidity is there, markets have got support.
So is the cycle quickening because of the the focus on short-term issuance over long-term over the last 5 or 6 years?
I don't think it's necessarily quickening. I think the sources of liquidity are changing. And, one of the things that you're, I think, highlighting implicitly there is that there's really a shift in the tenor of issuance by governments. The Federal Reserve has clearly moved towards the short end of the curve. There's been a lot of treasury bill rather than longer dated coupon issuance. That was a policy that was really started by Janet Yellen 2 or 3 years ago. But it's a policy that Scott Bessent, the new Treasury Secretary, is going to find it very, very difficult to decouple from. But on top of that, we've had Japan now talking about issuing at the shorter end. We've had the Brits talking about issuing shorter dated gilts. It's becoming flavour of the month among Treasury management offices, basically because it's much easier to sell that paper, very short-term paper. and it's a lot cheaper as well, given the fact that longer dated yields are rising. So that is a feature. Now, one of the issues for that, which is particularly relevant when it comes on to thinking about gold, precious metals, and monetary inflation hedges, is that the key question is who buys that paper, who buys the bills, who buys the short-dated debt. And the answer is that it's not the longer-term funds like pension funds or insurance companies. It tends to be banks. And if banks are buying government paper, by definition, they are monetizing the deficit. So this is effectively a plain and simple printing money. It's coming through the back door. People are not seeing it because it's effectively what you might call Treasury QE, not Federal Reserve QE. So people don't know where to look. But it's coming, it ultimately means the same thing. What's happening is money is being printed. And as money is being printed, effectively, paper money is being devalued and precious metals will go up and Bitcoin will go up and all these traditional monetary hedges will work.
So I definitely want to focus on the QE, the printing money side, but I want to ask you about the reliance on the short-term issuance. Is that going to continue indefinitely in your opinion? And if so, what's the impact to debt servicing costs down the line of this type of behavior? And is there ultimately a breaking point where maybe there's a brick wall there ahead of us that they're going to head into?
Well, yes, yes, and yes. The question is we don't know when, but we know from experience that monetization never ends well. We saw it through the 1970s. And what it took was severe monetary policies in the form of Paul Volcker to really straighten the world economy, or particularly the US economy, out again. And we're not quite at that point, but we're certainly moving in that direction. So I think one's got to be alert to these risks. The fact is that a little bit like drug taking, and that's the right analogy, issuing very short-term bills and short-term paper is a short-term fix, and it makes them feel good in the short term, but you can't sustain it in the long term. And the problem is, or maybe the incentive first, the incentive for doing this is that short-term paper is very, very easy to sell. There is a big market out there for short-term paper, particularly US dollar paper, certainly among the banks. And if you've got a very loose fiscal policy, think of what's happening to bank balance sheets. Deposits are rising because the government is writing checks in terms of wages or in terms of its spending, infrastructure or whatever. It's writing checks. People's bank balance sheet, bank deposit accounts are building up as a result of that. And the banks need to find an asset on the other side of their balance sheet to balance that increase in liabilities with. And what they tend to turn to is very short-dated government paper because it's A, low risk, and B, it has a very similar duration to a bank deposit. So the banks tend to be big buyers. The problem is that, as you can see from my analogy, what's happening here is that alongside, I should say, the rise in the deficit, banks' balance sheets are expanding. So effectively, the banking system is funding the increase in the government deficit, and that's really the problem. So can it go on forever? No. When's it going to end? We don't know. But it really comes down to a loss of confidence among investors in terms of buying government paper. There'll be a buyer's strike in some form. Now you can watch Treasury auctions and see, to what extent the issues are left with dealers. That's a possibility. That's a sign that the auctions are going badly. Or you can just watch yields soar, and that's the other risk, that you start to get yields at the long end building in a bigger term premium or a bigger risk premium, and it becomes very, very expensive for governments to start to fund the deficit. Now, their immediate reaction will be, and let's think about this one, they put pressure on central banks where they can to lower interest rates, and then they have another dose of funding at the short end of the market. But the trouble is this becomes a vicious circle, and it becomes worse and worse. And as you continue to print money, you devalue your paper currency and the price of gold goes up. And this is the reality that we've got to start thinking about. Now, that particular episode that I've described, this monetization of the deficit, is something that began, it's happened before, but it really began in spades under Janet Yellen. And she was the one that really shifted funding of the US deficit towards short-dated bills. Now, what I want to do is to show a chart, because I think a chart will effectively show that point.
Michael, while you're pulling up that chart, I do have a question. You may have answered it already in what you just said, but With all the macroeconomic conditions that are present today and really over the last 5 years, what's to stop this, as Lynn Alden says, this train of short-term issuance until we hit that brick wall? Is there anything, or is it inevitable that we're going to have the problem, the crisis that you just described?
Well, I hesitate to say that we're going to hit a brick wall and we're going to have a crisis. I mean, you've got to remember that governments have been in the business of spending money and running budget deficits for a long time. They're very experienced at devaluing paper money. Just think of what a US bill, $10 bill would be worth in say 1914 or the turn of the 20th century compared to today. I mean, clearly its buying power of $10 back then is hugely more than we have today. So devaluation of paper money is certainly nothing new, and it's gone on for a long time. And okay, there have been cycles en route, but generally speaking, the trend has been higher. And I think what you've got to do is to understand that in the context of what the gold price has been doing. Now, in this chart that I show that you should have in front of you, which is entitled and US real interest rates, what I'm really trying to show there is the break point. Now, if you look at this chart closely, what you can see is the orange line is the price of gold. The black line is US real interest rates inverted, so flipped over. So in other words, as you go up the page on the left-hand scale, real interest rates are falling. And as you go down the page on the left-hand side, real interest rates are rising. Now, typically, gold pays no interest, as we know, and therefore there's a cost of carry, an implicit cost of carry, which is your opportunity cost of not holding security that pays interest. And therefore, as real interest rates rise, the black line falls, the gold price should come down because that opportunity cost is increasing, and similarly vice versa. So what you see is a relationship that we've highlighted up until about 2022, when those two series move together. What you see in actual fact in late 22, around September, October of 2022, what happens is the black line and the orange line diverge. I've labeled that yellowonomics. That's where we began to move down this road of doing, let's say, irresponsible fiscal and monetary policies. And whether that was what I've labeled not QE, or not yield curve control, or whatever the acronym you think of, this is sort of loud and clear. This is an episode in Treasury QE that's going on. So despite the fact the public face of the Fed to say that they're doing QT, I mean, just forget that. They're clearly not. The markets are screaming they're not doing that. The gold market is telling you absolutely they're not doing that. What you're seeing is a devaluation of paper money, loud and clear, and that break point is obvious, and that is yellowonomics, and that continues.
So what conditions are you looking for that would reverse this trend or bring it back into the previous trend?
Well, the answer will be to cut down government spending. I mean, the fact is, as Scott Besson has very clearly pointed out, the US doesn't have a revenue problem. Tax revenues are pretty constant as a percent of GDP, nominal GDP. What America has, like many other countries, is a spending problem. And that spending problem was basically, emphasized by the GFC, emphasized by the COVID crisis, where politicians simply just wrote checks. And they're in the habit of doing that. And I think you can see, probably pretty clearly with the Doge experiment, if that's the right way of describing it, how much excess or corrupt spending has been going on. And the trouble is that Doge can't really cut that fast enough or big enough. It's out there, but it's a real problem. And that at the moment is being funded by monetization.
And Congress doesn't seem to have the appetite to cut it either. So
well, no, absolutely. Politicians won't do that. Yeah, they will lose the votes. This is sort of pork barrel politics, isn't it? I mean, at the end of the day.
So it doesn't seem like it's even possible to close these jaws. It seems like the jaws are going to get wider.
Yeah, exactly. I mean, just look at the experience of Latin America. You've only had two examples in Brazil, in the 1990s, where there was severe cutbacks in the government after massive inflation, or Argentina now under Milei. I mean, these are the only examples where the electorate just sort of throw their arms up and say, we've just had enough. But that clearly isn't happening yet in the West. And that is the problem. So the can gets kicked down the road. Lynn Alden is absolutely right. The train goes on. It keeps running. and nothing stops this train, and that's the reality. So what you've got to start to think about is this particular process. Now, what I can demonstrate, and I was going to show this a little bit later, but let me kind of jump onto it now because I think it's a very relevant point to make, is just this think about this chart, which is looking at the federal debt. This is marketable debt going right back to the 1940s in real terms, in other words, in gold terms. So this is, in other words, looking at total federal debt, and it's saying federal debt is, how many $1 million per ounce of federal debt there is. Okay. Now, if you look at that chart, what it's saying is that ratio between federal debt and gold has risen. Okay, fine. But actually, it's risen at around 1.5% per annum. That's trivial, right? I mean, no one's going to bother too much about that. So in other words, gold has pretty much kept its value over that period against federal debt. And the more federal debt that's in the system, the more monetization by definition there is, because that's how they pay for it. So they basically devalue paper money to pay for this expenditure. Now, what this is broadly saying is that if you can believe that channel that's there, and I'm just giving that as a representation, who knows? But if you get to that lower trend line, you're talking about $4,500 an ounce. Okay, if you break it and go down to previous lows, which was seen in 2007, you're up at what, $5,000 an ounce, over $5,000 an ounce. So there's an awful lot of scope in precious metals still to rise. And the point is that as long as governments are spending and as long as politicians are prepared to spend money and sanction it, the gold market's going to keep going up. Simple as that.
Interesting. All right. So now you also have a chart, Michael, that I thought I saw that you shared this morning. It shows a $70 trillion gap between the global liquidity, wholesale money, and world M2.
Yeah, I haven't got that in this pack, but that's a relatively straightforward analysis that we can show. But what I was trying, I mean, this is the liquidity cycle that you can see, and what I was trying to say, this was on a tweet, and I was saying, look, I mean, a lot of people are talking about M2. I mean, that's a convenient thing to measure because it's straightforward and it's readily available. It doesn't really have a great deal of value in terms of prediction. I mean, it's not too bad. It trends maybe with a lot of variables. But what you really want to understand is the flow of money through financial markets. And that's really the key thing that's driving asset prices. And what I was trying to say in that particular tweet was that, look, global liquidity is an aggregate which totals about $180 trillion. M2 money supply, which is easier to calculate. We spend a lot of time calculating the 180 trillion every month, but the 110 is an easy number to calibrate. But that 70 trillion gap is equivalent to more than 2 US economies. So, let's get realistic here. We need to look at the proper data, the true data, and that's global liquidity. This is the cycle and the momentum of global liquidity. What we show there is that regular 5 to 6 year cycle, 65 months. That's a refi cycle. What you can see is the movement recently. The cycles are pretty much tracked according to that notional sine wave. That sine wave was put in place in year 2000. It's been, or estimated in the year 2000, it's been run forward 25 years since that time without any change. It was recently cross-checked by the Foundation for the Institute of Cycle Research, and they found an absolutely equivalent 65-month periodicity of this data. So they have found exactly the same cycle. And what we've done is try to extrapolate the cycle, bringing into account two factors. One is that the dollar is weakening, and number two, that the world economy is slow, and that should impart further liquidity into the system. Why does the cycle inflect, which is clearly an important thing to understand? And that is because we believe that come next year, there'll still be embedded inflation problems in the economy. And we think that therefore central banks will try and wrestle back some control. And secondly, what you've got is the likelihood of something called the debt maturity wall appearing. Now, the debt maturity wall is basically debt that is coming back into the system to be refinanced that was termed out during the COVID crisis when interest rates were near zero. So a lot of corporations and governments thought, aha, zero interest rates. This is, nirvana here. We can just basically issue debt much, much lower coupon, and that will last for maybe 6, 7 years. But clearly it's going to come back into the system now, 2026, 27, 28, at much higher interest rates. And that's got to be financed. And that's a bogey we've got to jump, upcoming.
Okay, so that's interesting. It's almost like you're peering over my shoulder, because that was a question I was going to have, was about that debt maturity wall. So can you put in context the what we're looking at here with the global liquidity cycle and that downturn heading into, say, 2027, 2028 that we're looking at there, alongside, and how that impacts the debt maturity wall that's coming through?
Yeah, let me do that in two stages. One is, what impact does it have on asset prices? So this is actually only up until the back end of 2025, early 26. So what this is saying is looking at global liquidity. Global liquidity is a key driver of world wealth, and the black line is basically illustrating the value of all financial assets worldwide. It also includes, by the way, residential real estate, all financial assets, crypto, precious metals, bonds, equities, liquid assets. Every country in the world is included. So what you've got here is all world wealth, and that is, as you can see, a very, very close or has close connection with global liquidity. So as global liquidity expands, it basically pushes asset prices up, and that's really what we want. The other dimension, though, is this one, which you're alluding to, which is effectively financial stability. And one of the things that many economists talk about, we think incorrectly, is that what matters is the debt GDP ratio. What they fail to explain is why the debt GDP ratio is 250% in Singapore, maybe 300% in China, is whatever it may be, 200% in Japan, 100% in the US, and yet these benchmarks differ. But no one seems to be having a crisis right now. So does debt GDP really make any difference? And what we're arguing is that it's not the right benchmark. What you need to look at is debt to liquidity, because debt has to be rolled over. And if there's not the liquidity in the system to refinance the debt, you get a crisis. And therefore, if you look at this chart, which shows debt as a percentage of total global liquidity, obviously this is just for the advanced economies, it shows that there's a long-term average of about 2 to 1. In other words, debt to liquidity is about 2 to 1. That's what the dotted line is showing. Anywhere above that 2 times ratio, you find there are refinancing tensions appearing in the world economy. In other words, it's very difficult to get the liquidity you need, and there's a debt crisis. And you can see all those annotations that we've illustrated where you get financial crises coincident with high debt liquidity ratios. And then on the counter side of that, you can see that when debt is very low relative to liquidity, there's abundant liquidity, you find that there are asset bubbles. Now, what we've just come through is maybe the biggest asset bubble, which is what I've labeled the cryptocurrency boom, or the everything boom. And that was because, number one, the GFC injected liquidity. Number two, the COVID crisis injected liquidity. Number three, interest rates were slashed to zero, forcing or encouraging many issuers to term out debt to later in the decade, 26, 27, 28, as we've been saying. Now, what the chart is showing is we don't go into, let's say, hugely positive territory or above that dotted line, danger point, but we certainly get back to the average. And that is because the debt maturity wall comes back. In other words, debt is coming back into the system to be refinanced. That orange line starts to shoot northwards in the projection period. And global liquidity, we suspect, because of the inflation issue, is not really as forthcoming as it has been. So that's the issue. Will we get a crisis? It's possible. Nothing's certain, clearly. But what we've got to look at is this diagram, which is what we try and show.
Michael, before you go off that other chart there for 1 second, you were just starting to say, will we have a crisis? Will we not? That was a question I had coming up here. Let's just settle in right there for a moment about this potential liquidity squeeze where the financial system would tighten, making it harder for institutions, businesses, and individuals to access funds unless central banks intervene with stimulus of some kind, right? So, so here that line is jetting, you know, parabolically north since 2022, 2023. It's now touching that dotted line. Like you said, that's the average. That's not the crisis point. But do you see a scenario unfolding of likelihood where we could have this liquidity squeeze? And if so, what are the impacts to the economy and markets in that kind of scenario?
Yeah, we could. I mean, make no mistake. I mean, the system is cyclical, and we go from boom to bust, and we go from from benign to crisis periods. That's the nature of the financial system. Just for reference, the shaded area begins in 2025. This is because this is annual data. It looks as if it's coming earlier, but that's what. So the last observation, the true observation, is 2024. So what we're starting to see is that line climb. Now, will we get a crisis? Yes. How do you understand that? This is the debt liquidity cycle. This is broadly how the world economy or world financial system works. Financial stability requires a robust or stable debt liquidity ratio. On the left-hand side, as debt is converted into liquidity, you operate through the repo collateral markets, and as liquidity is used to refinance debt, that's a refinancing transaction. On the left, to see whether that circuit is going wrong, you need to look at SOFR spreads or the Mnt&x. And on the right-hand side, to see if things are going wrong, look at term premium or credit spreads. And that's how we tend to look at it. What we've got to remember is the whole nature of the financial system has changed. It's not according to the textbooks. The textbooks are way out of date. They're sort of on a cloud somewhere. They're divorced from reality. Almost 80% of global lending now is collateral based, and something like 70 to 80% of transactions in financial markets are refinancing existing debts. Our system is dominated by debt. This chart looks at whether you are getting a blowout in SOFR spreads. SOFR are repo rates, Fed funds, that's the FF, so the spread of SOFR against Fed funds is a metric to watch. This is showing the recent history, looking at daily observations. What you can see is when you get above that upper trend line, there's a danger sign. We've had a lot more of those recently. Watch this space. We're in a decent zone at the moment. I would suspect, looking at the recent actions, the Federal Reserve is targeting this. They don't want that SOFR spread to stray. Are they able to target it? Who knows? We'll see. But that's what they're effectively trying to do.
Okay, so you mentioned that we will get a crisis at some point.
Yeah.
So that is locked. That is locked in place. It just comes down to when, in your opinion.
Yeah. Now, here is the sort of the thing to watch. This is the projected growth in Fed liquidity, how much liquidity the Federal Reserve is slated to inject in the US financial markets. Now, this is showing actual and our projections based on what they're telling us. The big cause, or the key cause of that plunge in liquidity in the second half of the year, is the prospective rebuild of the Treasury General Account. Recall that Treasury General Account has been run down because of the debt ceiling and various other factors, but that's been run down. That is a reserve that the Treasury hold at the Federal Reserve. If that is run down, money is injected into financial markets. That's one of the reasons there's lots of liquidity at the moment. But if the Treasury want to rebuild that account, they will prospectively be forced to take out half a trillion dollars. Say that again, $500 billion out of US money markets. Can they do that in current circumstances without upsetting the apple cart? No way can they do that, in my judgment. That's a big ask. Either they're going to have to change their policy and inject liquidity formally back into the system, or the Treasury is not going to be able to rebuild the TGA. So this is, or if they do, you get financial instability. So that's something to watch. And I'll come on to what I think the way out is in a moment.
Do you have a projected timeline? Is it 12 months, 24 months, 36 months?
Well, let me cut to the chase after this chart. What this is showing is the other thing to watch, which is volatility in the bond market. The Treasury is actively trying to get that down now through things like Treasury buybacks and probably attempts to change the parameters for the SLR, the supplementary liquidity ratio, encouraging banks to buy more Treasuries, and that will help the liquidity in the market. So they're actively trying to do that, but the more that this volatility in bond markets blows out, again, the higher risk. Now, what is the way out for the Treasury and the Federal Reserve? And I would argue it's basically this. What this is basically showing is three forms of stimulus for the system, liquidity stimulus. The red area, as you can see there, or as labelled, is traditional QE, quantitative easing. So that's basically the the Federal Reserve buying treasuries in the open market, and that's injecting liquidity into US money markets. The orange area is what we sort of tongue-in-cheek call not QE, which is other forms of injection of liquidity, whether it's running down the TGA, whether it's support measures for the banks, such as the Bank Term Lending Funding Program, or whether it's the reverse repo program running that down. Those are all forms of liquidity injection that are outside of formal QT or QE, but that's another source of liquidity, which was very important in 2023-24. And then the black area is what I've called not yield curve control, which is a bit of a mouthful, but think of that as Treasury QE. That's basically the Treasury saying, we're going to alter the tenor of funding. We're not going to fund in terms of 10-year coupons or longer dated debt. We're going to fund through the bill market or short dated coupons. That is a liquidity injection because, broadly speaking, how can you generically define liquidity? It's an asset divided by the asset's duration. So if you reduce the duration of your asset pool, you're going to increase liquidity. And that's really what's going on. So effectively, the black area is the new stimulus. You can see that the effect of increasingly funding at the short end of the market, which we're projecting, is giving in that projection period further stimulus. It is not quite as big as the 2024 one, 2023-24 one you can see, but it gets close. It sort of adds up to about 2 trillion in effective liquidity stimulus. So there's more support coming. So this is the way out in terms of what I can see. This is another way of trying to square the circle. But eyes are on the Fed. They shouldn't be on the Fed only. Look at the Treasury. The two are working together.
All the support that you're talking about here, the not yield curve control, the QE, the not QE, all of that, I'm assuming is a headwind, a tailwind, so to speak, for gold.
Yeah, absolutely. I mean, this is stealth QE monetization. I mean, look at this chart. This will bring it home. This is looking at money supply, traditional money supply, M2 for the US in red. The growth rate, and the orange line is holdings of Treasury securities by the banks. The banks are buying Treasury securities with some alacrity. They're growing a lot faster than money supply. That's the source of growth in banks' balance sheets. And if they change the SLR rules, it's quite likely, which we're told they're going to, it's going to increase the growth in agency and Treasury holdings by banks, and that's monetization again. So what you see is what you get. This is direct monetization, and it's happening now. This isn't just a US problem. I mean, as I've probably said many times before, I mean, the US in many cases may be the cleanest shirt in the laundry. I mean, that may be a bit of a jump after recent policy statements, but let's hold that thought. What about China? This is injections by the People's Bank into Chinese financial markets, Chinese money markets. And you can see that as of this is rolling 6 months to get out the volatility, and it's seasonally adjusted. And what they've been doing over the last 6 months is injecting over 8 trillion yuan, which is what $1.25 trillion US dollars. I reckon they've got to do twice that to get out of their debt problems. So what you're looking at is a significant boost to gold prices. I think this is not just about the US; it's about other countries too.
And each year, it looks like per your chart there, each year since 22, the People's Bank is increasing their injection cycle.
Yeah, exactly.
Yeah. So to your point that it's going to go up to 16. Yeah.
And it may well be that they're deliberately targeting the price of gold. I mean, why not? China's the biggest gold producer. They've got some of the biggest stashes of gold, so it's kind of in their interest to do that. So, what you see in all this is a relationship between monetary inflation, as we call it, which is basically this printing of money, this expansion in global liquidity. This is monetary inflation and the prices of monetary inflation hedges. And one of our favorite charts is this one, which is looking at Bitcoin. This is showing Bitcoin. I shouldn't be saying this to an audience of people who like gold, but nonetheless, gold is an equivalent monetary inflation hedge. Bitcoin happens to be a new alternative. And what this one is showing is 6-week changes in the price of Bitcoin, which is in orange, and 6-week changes in global liquidity, our weekly index of global liquidity, in black. And that black line has been shifted forward by 3 months. And what you see is a very high degree of correlation. The R squared on that data is about 0.25, which is telling you how strong the relationship is. And it's statistically, it's very Granger causal. So what you find here is that, Bitcoin is a straightforward monetary inflation hedge. And the more monetary inflation you have, the higher the price. I showed you this chart. This is the one showing gold in a broader sense. Federal debt is paid for by monetization in the long run, and the gold price keeps pace with that pretty much. And we're heading higher for gold. And then the other thing to say is about what about other asset classes? Well, the way that I would tend to think about this is to think of one of my sort of favorite diagrams, but I've got to explain this one, but let me try. This is really trying to understand where bonds and equities fit into this. And if you've got monetary inflation going on, which is what we're arguing, which is that lower axis, okay, and that translates through into high street inflation. So in other words, CPI inflation of 2, 3, 4% or whatever it may be. How are equity and bond markets valued in that context? Now, if you look at fixed income markets, bond markets, the red line is pretty much indicating how bonds are valued. So what that says is if you go towards deflation on the left, okay, very low inflation on deflation, the valuation of bonds tends to go exponential. So yields get lower and lower and lower, and prices, start to rocket, and your returns on bonds go up significantly. And that's what that line is pretty much saying. So in other words, you might say that the implicit PE multiple of a bond is going up hugely as you get towards low inflation or deflation. If you go towards inflation, it goes the other way. If you think about real assets, which I haven't got on that chart, they are the mirror image of that fixed income line. So they would be revaluing from low points on the lower left towards high levels on the upper right. But what about equities? That's an interesting point to ponder. Equities, curiously, have a bell-shaped valuation curve against inflation. And you can see that. We've written many, many times over the years about this. And you can see it in the data. It's very clear in the data. And the data we use is the Robert Shiller database that goes all the way back to, I think, 1880. But if you look at that data, you can track this easily. What it shows is that there's a bell curve for valuation. In other words, the highest equity valuations are around 2 to 3% inflation. And the lowest are either side of that when you get towards deflation or very high inflation. So valuations fall away. So you get that sweet spot. Now, the interesting point to note is that where we've drawn that dividing line, if you like, the orange dotted line that runs from the peak to the axis, that vertical line, anywhere to the left of that, bonds and equities are negatively correlated. And anywhere to the right of that, equities and bonds are positively correlated. So what that's really saying is, as you move towards a higher inflation environment, you're going to want to have more equities and bonds in a portfolio. But if you start to get towards higher levels of inflation, equities and bonds will probably derate together. Equities may be a tad better in performance, but that's what you have. Interestingly, if you look at the left-hand side of the diagram, we've basically annotated that with notionally with Chinese equities, Japanese equities, European equities, and US equities. And what that's saying is that the US has more of an inflation problem than anywhere else. Okay, Japan is picking up an inflation problem, but it's coming from very low levels. So what you should be seeing in Japan, in China, and maybe you've already seen it in Europe, is an upward re-rating of their equity markets at the same time as the US sees a de-rating because of rising inflation pressures. And make no mistake, the tariff hikes will be inflationary, at least in the short term, although in the longer term they may be deflationary because it's equivalent to a tax increase. But they'll lead to, or they'll embed a stagflationary mentality, among investors in the US.
So essentially what you're saying is inflation up, bonds and US equities down, emerging markets equities up, gold and Bitcoin up.
Correct. Absolutely. Now, whether you want to take the geopolitical risk in Chinese equities, that's up to you. But that's what you should be seeing in terms of this diagram. And what it's saying is that, as you're moving towards this threshold of 2 to 3% inflation, what you're getting is an upward re-rating of equities in these markets, particularly vis-a-vis fixed income. China is in deflation as we speak. Japan is moving out of deflation towards higher inflation levels, and Japanese equities should re-rate.
I really appreciate the walkthrough here through all the charts. I just want to point out to everyone, this has been a wonderful discussion. I want to welcome everyone tuning into this discussion with Michael Howell, founder of CrossBorder Capital. He always has so much information and data to share, but more than that, the explanations, are simplified for everyone to understand, and we really appreciate that. Before we wrap up with our final set of questions for Michael, I want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. That's also the title of the report. Consider upgrading to access to premium content, but even without premium, there's plenty of free content daily. So visit metalsandminers.substack.com to join and explore. And thank you so much for watching this interview. Now, I'm positive that you've been enjoying this back and forth discussion and this education that we're getting from Michael as much as I have. Please let him know by hitting the like and subscribe button and leave a comment below the video. All right, Michael, when we were talking off camera, I mentioned a lightning round. I'm gonna ask you to rank a few assets as a buy or a sell, with a 100 being an extreme buy, a 1 being an extreme sell. Then just give 1 or 2 sentences as to why you take the position. We're going to try to run through these pretty quick. All right.
What's the time horizon?
What's that?
What's the time horizon?
I would say for the next 6 to 12 months, starting now. Yeah.
Okay.
Yeah. On a scale of 1 to 100, is gold a buy or a sell, and why?
Oh, I think I'd be up at 80, 90 on gold. It looks a little bit overbought near term, but I think the dynamics, as I've explained, are very positive. If you believe that debt is going to increase, gold has to go up with debt in the long term.
Okay. Gold miners.
Well, I think by definition, they should be similar. I think the only question about gold miners is that it's a little bit of an esoteric area, and liquidity in that area of the market has often been suspect. But I think logically they should do well, and one would have to give a similar rating. In fact, maybe even a slightly higher rating, given the fact they've underperformed so much.
That's the truth. All right, physical silver.
Oh, silver, I'd be higher. I'd be near 100% in the silver, because I think the thing is that silver, as they nickname it, the restless metal, it always tends to gyrate much more than people can predict. But on the other hand, the fact is it's very cheap at the moment. Precious metals are going up. It looks to be, among speculators, very under-owned, and it looks as if the silver price is now catching a bid. So I'd be very upbeat on silver.
And knowing that there's only so many silver miners, where do you rank the silver miners?
Well, that's not an area I know very much about, so it's very difficult. But I can't go more than 100, can I?
Okay. Copper.
Copper, I think in the longer term, copper is key. So it would be, if I go beyond your 12-month horizon, I'd have copper up there. I mean, I'm very keen on this area of the commodity space. I think the only question about near term is the extent to which copper is really a hostage to slower economic growth in the world economy, in a way that gold and silver isn't. But I mean, broadly, on a longer term view, it would be up there equivalent to gold and silver.
Okay, so on the short term, you might have it where like a 50 or 60, in the long term.
Yeah, maybe a 60, something like
Yeah.
that.
Okay. Physical uranium, the metal.
Well, I think that I'm going to have to say somewhere similar to copper, so a 50 or 60. Really because I mean, one is that uranium is one of those assets that always tempting, is always logical, but it never seems to perform. And I think one's got to be cognizant of that fact. Nonetheless, the fundamentals look compelling. The move towards more nuclear power is, irresistible, and so you'd have to make the case that this looks a great investment. As I said, the problem is that it never really seems to fulfill. And the problem is that, with a lot of uranium miners, I mean, these are very, very high capital costs. And the question is, are these great businesses? I don't know. I mean, that's much more a micro question.
Okay. Oil.
Oil, I think, is I would just have to say a 50, because I think the question with oil is it's geopolitical, and it's really, it's like Nero's thumb. Are the Saudis going to print more or less? It's hostage to to Middle East political tensions, Russian political tensions. I mean, if there's a solution to the Ukrainian crisis quickly, we may get oil back on the stream fast. In the West at least. So there's a lot of imponderables. I think it's a difficult one, therefore I'd have to be lower in that rate.
NASDAQ.
NASDAQ, I think it's sort of a little bit like maybe the answer to copper. I think a sort of 60, maybe 70. I think long-term technology has got to be great, because that's our future. I think that, the issue is that, if you've got a cloud over the general US market, it may not fulfill its potential short term. So I think that it's one of these things. I'd definitely be buying it on weakness, but I wouldn't be chasing it right now.
Okay, Michael, would you please share a key takeaway that you want viewers to keep in mind about today's economic, market, or monetary situation, and then just let everyone know where they could learn more about your work and how they can connect with you?
I think the first thing to say is that liquidity is really a critical factor to watch. It may not be the only factor that drives markets, but it's clearly an important one. And I think people are going to understand why and try and find ways of monitoring it. I think the second thing is that it's vital for financial stability. And if you can't watch liquidity directly, what I'd be looking at is some of these very sensitive interest rate spreads, such as the repo spread in the US markets, as a guide to whether we're about to derail or not. In terms of getting in touch with us, the easiest way is through Substack. We write a Substack 2 or 3 times a week called Capital Wars, which contains liquidity data and analyses. Or if you want access to our full data, which is really an institutional product, it's crossbordercapital.com. And we have a Twitter handle at CrossBorderCap.
I will have all of that information up on the screen and in the description area to click through. Michael, thanks for coming on to Metals and Miners. As always, you're so generous with your time and your analysis and ideas, and we really appreciate it. We look forward to having you back on sometime soon. Everybody else, thank you for watching.
Thank you. Enjoyed it.
I just want to point out to everyone, this has been a wonderful discussion. I want to welcome everyone tuning into this discussion with Michael Howell, founder of CrossBorder Capital. He always has so much information and data to share, but more than that, the explanations, are simplified for everyone to understand, and we really appreciate that. Before we wrap up with our final set of questions for Michael, I want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. That's also the title of the report.